In this week's update, how your thinking needs to change to be a great investor, the incredible history of gains following the start of rate cuts, and small caps finally getting the love. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, just continuation of really fascinating weeks and obviously very positive weeks as well. So I want to put a focus on being a great investor. What are the things that you've got to do to get better at the process of investing? And the question I would ask, immediately is why settle for mediocrity, which is what I think a lot of people are doing, probably because of lack of information, lack of knowledge, but you really don't have to settle for being a mediocre investor, just following the crowd. But what you do need to do is to change your thinking, and change your thinking quite significantly. And it's not very hard at all. You just need a bit of a guide to the way to actually go about it. And it's got nothing to do with so-called owning blue chip stocks. I mean, I don't understand what that term is anyway. It's a meaningless term to me. It has nothing to do with stocks that are in the top 200. It has nothing to do with the fact that a lot of people think that because a stock has a larger market cap that it must be somehow safer. Well, history shows that that is absolutely not the case. It has nothing to do with stocks that are household names, stocks that you think you should own because everybody else does, or stocks that just fall under the general category of conventional wisdom. So it's absolutely none of that. And there is a massive gap when you really understand the market and you're immersed in the market for decades, as I've been. There is a massive gap between the accepted wisdom that everybody just sort of nods and takes as a given and the actual market reality. And it's that huge gap that holds investors back and limits the sort of return that they can get from the market that can be quite wealth changing. From my perspective, and I've been progressively shifting and being forced to shift my perspective on the market over time, there are really only two types of investments. One type is where the stock has a high probability, or the advancement of the company has a high probability of playing out in a predictable, repeatable manner. That's it. You want a positive outcome over time and you want it to happen with a very high degree of probability. And the rest are just distractions. So that's the way that I see the market. It's just the probability of getting a strongly positive outcome over time and to be able to do it in a repeatable manner. So let's unpack that a little bit and look at what I regard as highly predictable, high growth businesses, because that's where you're going to build your wealth. And from my perspective, that's the only lens that I look through. If I don't believe that a stock has a high probability of being able to generate more than 20% per annum return over a period of 2 to 5 years, then I'm just not interested. It doesn't even get on my radar. So that's the lens that I look through. Now, that doesn't mean that every selection I make achieves that. Of course it doesn't. But if that's your starting point, then you end up with a lot more high-performing businesses than otherwise. And it can be any sector, any industry group, it can be any market cap. It doesn't matter to me. I don't care. It just has to reliably make me money. That's the lens that I look through. And if you really narrow your focus to only consider those sort of stocks, it is such a liberating mindset to be in, because you're not caught up with all this indecision about all the other stuff that you think you should own or that you want to own. So the first essential step in this, and this is difficult, is to discount everything that you know or think you know, because most of it is just junk. It really is. And it holds you back because it puts incorrect ideas in your mind about how to make money out of the market and how to build wealth over time. So that's the first essential step, is to recognize that don't accept anything that you currently take as a given, because it is costing you big time. And certainly the results that members are reporting back to us that they've been getting in the market, validate what I'm saying here. Previously, they were getting mediocre results, and now their results have improved dramatically. And it all gets down to the fact that they started a process where they changed their thinking about the market, how they viewed the market. So the essential thinking journey is this. You need clarity of purpose about what it is that you want to get out of the market and the process that's suitable specifically for you. And that then gives you a reliable track to run on, gives you a repeatable process. Now, for lots of investors, that is a difficult first step, or seemingly a difficult first step, but it's actually really simple. You can nut it out in 10 minutes with a bit of guidance. So it's a really simple, straightforward process. And it's tailored specifically for what you want, not against some one-size-fits-all kind of concept. The second step is then to put yourself in an environment and a mindset where you can execute that proven process reliably. And if you can do those two things, then you're well on your way. And then it's just a matter of repeating that for long enough so that you build self-confidence over time. You start to trust your judgment. And the simpler you can make this process, the better, because complicated just does not work. So if you think this is some sort of onerous process that you've got to buy into, then you better think again, because the simplicity is very much the route to get a winning process here. So there's some things to do and not to do, and there's a very large list here, but here's just a couple of the key ones. You should only think in terms of risk and reward. Get rid of those thoughts that, I can't sell this stock because I'm making a loss. It's purely about the risk and reward around that parcel of money. If you've lost some money on a particular stock and the price is falling, then the chances are you're probably going to lose even more. So why not move that parcel of money into something that's going up? So think in terms of risk and reward. Forget your favourite stocks, because what that does, it sets up a circle of thought, a circle of emotion that just creates awful behaviours. It leads you to pay more for stocks that you want to buy that might have escalated quickly. Fear of missing out, all those sort of things kick in. Or it may influence you to hold on to stocks that you really should be selling and getting out of for either fundamental or technical reasons. So having favourites, stocks that you really like and you feel that you should own, really is a very limiting behaviour. You need to be very ruthless about the market and how you think about it. We're in it to make money. That's it. We're not in it to own our favourite stocks. And we definitely don't want to end up holding onto a kennel of really dog stocks because we have this perception or this fear about selling out. If we sell out now and take a loss, then I bet the share price is going to go up. You just got to get rid of all that junk out of your mind because it absolutely holds you back. All right, so there's just some opening thoughts on how you can, in a pretty straightforward manner, become a far better investor over time. Let's look at the US market status. The Fed cut interest rates as expected. What forced their hand in the end? Because whilst inflation has been moderating, it's still above their band. The CPI moved up from 2.7 to 2.9, so it's still above where they want to be. And Jeremy Powell has been resisting Trump's pressure for quite some time, as everybody knows. But they finally had to cave in when the weak labour market made it pretty obvious that they needed to do something. So they've got a dual mandate about the strength of the labour market and inflation. They've had to de-emphasise inflation as their main decision-making point, and they've gone with protecting the labour market as much as they can. And the odds are that there will be another one or two rate cuts by the end of the year. Now, if we look at the earnings outlook, Q2 was really, really strong. 81% of S&P stocks beat on earnings. That's a high number. And also the percentage average gain was also right up there and significantly above expectations. I think expectations were somewhere around about 6% average growth, and it ended up nearly double that. So Q2 was very, very good, and that's why we've seen such buoyancy in the market. Now, Q3 earnings might ease a little bit, but the consensus seems to be that it's not going to push towards, they're not going to ease sufficiently to lead the US economy into recessionary conditions. It's interesting to look at history. You don't want to rely on this totally because it's no guarantee, but what follows, what is the history of what follows the start of a cycle of cutting rates? And a couple of different sources here, one from Bloomberg. The average gain in the S&P 12 months later after rate cuts started was 15.5% with a 93% probability that that's how it plays out. There was also the Carson Investment Review, which has looked at the period from 1980 when rate cuts started, when the market was near the all-time highs. And the S&P 1 year later was higher 20 out of 20 times. So again, no guarantees here, but this tells us that we've got the odds very much on our side and we've got a pretty strong tailwind behind us. Now, just a quote that I couldn't resist. You might remember from last week, I made quite a few comments about the use of AI and essentially turning over your investing responsibility to AI to drive it for you. So there's a great comment that I saw from the Australian. AI is never going to replace an educated individual who understands investing. Trading and investing have lasted for centuries because they are skills you sharpen, not shortcuts you take. And I think they're extremely appropriate words. All right, where do we stand right now with the start of the rate cutting cycle? Well, I think there is a very high probability, I mean, history tells us this, of positive sentiment remaining for the next at least 1 to 2 to 3 years. So that is the backdrop. Now, it doesn't guarantee anything, either for the general market or for individual stocks, but it certainly is a big helping hand. And it means stocks that deserve to rise can do so and probably will do so. However, the word of warning is, we know that in many areas of the market, valuations are stretched. So if you're relying on a rising tide lifting all boats, then that is far more dangerous in this kind of elevated valuation market. Now, a lot of stocks trading on high PEs are still good deals because their growth rates are just so superior. So this is not an across-the-board situation. Many high PE stocks deserve that high PE rating. But expecting the whole market just to keep rising is not a good thing to do at all. So we need to be very discerning in selection. It goes back to what I said earlier, and that is there's two types of investments, the ones that have got a high probability of making you money, and then there's the rest, all the distractions. So we need to be very discerning, make sure that we're fishing in the right areas, and we're only thinking about investments in terms of risk and reward and probability. And we just shut out all the other stuff, all the stuff that's lurking around in the back of your brain about what you should own, because most of it is just really quite misleading. And as always, we strongly advise that you obtain all the relevant information that you need in the broader sense, financial, legal, and any other advice before taking action on anything that's in this video. All right, let's hone in now on the American market. The S&P was up 1.2% for the week, and the NASDAQ was up by 2.2%. And that's a pretty good week. Anything over a couple of percent for the main indices is a good solid week. September month to date, the S&P is up 3.15% and 5.5% for the NASDAQ. So you can see it was a good week, but it's also been a really, really good month as well. So only 3 weeks in, and the NASDAQ is averaging almost 2% a week in terms of gain. So much for September being one of the weaker months of the year. And what is the message we could take from that? Well, the obvious message is that there is a lot of liquidity chasing a relatively smaller amount of stocks, and the market is operating in a very, very positive mindset. And you could do worse than just following existing momentum. Now, you need to be keeping an eye on that changing and weakening, but that's something that I do in this video every week. But for now, we stay with what is, and that is we've got a very, very strong market with terrific momentum. And turning to smaller caps, the Russell 2000 was up 3.4% for September as well, and sitting around all-time highs. The final comment I'll make on the US market is rate cuts do tend to favour small cap stocks for numerous reasons. It's funding costs and a number of other factors as well. And we're seeing the performance of small caps really picking up. The US dollar index slightly higher thanks to the finish on Thursday and Friday at 97.66. The 10-year yield edged back up again to 4.13 and the VIX was sitting around 15.5. Let's go and look at the charts. We'll start with the NASDAQ. This is a weekly chart and you can see that it's really been sprinting, hardly a backward step since the lows we saw in April. There's just been the odd week here and there, but it's been a meteoric rise and we've risen from basically 15,000 and we're now at 22,600. So that's been a stunning rebound from that mayhem that we saw in March and April around tariffs. All right, we've now got the NASDAQ clearly outperforming the S&P, so the market is very much focused on growth stocks and particularly on tech stocks as well, as you'll see in a minute. Consumer discretionary versus consumer staples. Clearly, money is feeling very, very confident and discretionary is considerably outperforming the consumer staples. And we'll look at that now. And you can see here's consumer staples right down at the bottom and trending down. And then we've got consumer discretionary in the red doing really well. In fact, in third place behind communication services and general technology. So that's a very strong setup when the US market is diverging like that. Another important chart, and this is a really classic bullish pattern here, is SMH, the semiconductor index. We've had a breakout, a few weeks of undecided price action, bit of backwards and forwards, then retested the breakout. And now the last 3 weeks, we've had a really hard bounce off that retest. So breakout, retest, and then go hard from there is a very, very good sign for semiconductors. And when semiconductors are doing well, you've heard me say many, many times, the market in general is doing well. The US chart we looked at, if we move now to Australia, small caps are leading the way, and you can see they're trending up and they're diverging. So they've caught up from being somewhere down, way down here, and they're now leading the way in terms of the sectors in Australia. Energy, of course, has fallen right away quite dramatically with the failure of that deal to take over Santos. We've got a big gap down to finance, the banks. Information technology is making a comeback over the last quarter. So that's where we sit. The S&P looks pretty similar to the NASDAQ, but just not quite as much in percentage terms. And finally, this is the Russell. We did have an intra-week breakout to a new all-time high. Wasn't able to hold it, just pulled back a little bit on Friday, but this is all looking extremely positive. And if we put this on a daily chart, you can see prior to Friday's retest, it was looking extremely positive. So that's where we sit with the US market. The Aussie market, dollar finished 65.5. The market is pricing in a November rate cut at around about 70% probability at this stage. Our index fell 1% for the week, but gold stocks were a big winner as brokers finally get around to putting some upgrades into place that are long, long overdue, because the amount of free cash flow that is being generated from the Australian producers is really quite stunning. And you'll see in a minute with the gold price obviously supporting that greatly. Now, the US-UK nuclear deal is a possible boost for our uranium stocks, but this is an area where you just need to be very careful. And again, don't accept conventional wisdom here, because there certainly are some production issues with stocks like Boss Energy, for instance. So it's not an automatic that a rising uranium price or a better uranium outlook in terms of supply and demand is going to translate immediately to a higher share price for the uranium producers. So certainly some care needs to be taken there. And the major banks, of course, are still suffering from some valuation headwinds from all that irrationality that we'd seen over the prior couple of years. Turning now to precious metals, gold was up another $44 to $36.86, did go above 3,700 briefly. Translate that to Australian dollars, we're almost at 5,600, so it's no wonder that the Australian producers are making so much money. Silver continues to move up very strongly. It's at 43.09. I was interested to read the World Gold Council have a number of initiatives underway and have had for a couple of years that will create huge tailwinds longer term for a higher gold credibility to be accepted more as a key part of the investment landscape. And that's all wrapped up with digitisation of gold as well, making it more acceptable, so more credible and more accessible to investors. So I think the long-term outlook, whilst gold can always be volatile, the long-term outlook for gold, it's hard not to be bullish. It really is. Now, turning to individual gold stocks, the GDX ETF listed on the Australian market was slightly lower, but it was such a good night on Friday night that I think we should see a pretty positive session tomorrow for Australian gold producers. Let's go and look at some charts. We'll start with silver. So that's silver on a weekly chart. So you can see since the breakout around 35 and a bit, which occurred at the end of May, it's been a very, very strong move. So we've moved up $8 on the silver price since basically the start of June. So it's a very, very powerful trend for silver. In US dollars, on a weekly basis, you can see we've now had 5 positive weeks, pretty strong. We've moved from around 33.30 and we closed at 36.85. So very powerful move also in gold. And put that in Australian dollar terms, it's even moving up, breaking out of this consolidation that we had for quite a period of time, because the Australian dollar is not going up as quickly as the gold price is. So that's now translating to a re-acceleration in the Australian dollar gold price. Okay, let's move on to other commodities. Copper is at $4.57, was up very slightly. There are a few supply risks, not a great deal, and that's why there wasn't much movement in the copper price. There's some strikes and geopolitical issues in South America and Chile and Peru, which are major producers. Crude oil, 62.72, and of course we've just always seemed to have geopolitics around Russia, Ukraine, the Middle East, which is pushing the oil price up and down in an unpredictable manner. So this definitely does not fit into my lens of high probability because it's extremely unpredictable. I'd rather just leave it alone. We've got the US dollar trajectory on balance moving down. It was up slightly last week, but on balance, the trend is definitely down. So that's a positive for the crude oil price. And of course, US government policy around energy, well, who knows? Again, a big point of unpredictability. There's the spot copper chart. You can see we've got a very slight rising trend after all the consequences of whether there would be tariffs on copper or not, which caused a fair bit of short-term disruption. I thought this chart was interesting. This is lithium carbonate, and we've had a very significant spike, which was associated with a major mine being closed in China. It's now apparently coming back online early. So again, this is a market that is very unpredictable because, as you can see, either closing, suspending, or bringing back online a single major mine in China has an enormous impact on this particular market. Now, the market is pretty immature at this point in time in terms of the accuracy of price discovery. There's a lot of speculation going on in here. So again, this puts the whole lithium sector in unpredictability category for me. I would rather leave it until things become clearer, far more predictable, pay a higher price, yes, but your odds of success are much higher. So again, this is one of those change of thinking. I know some people have been just itching to get back into the lithium market because it's exciting. It was exciting for a number of years just after COVID. But if you can't reliably make money out of it, then I'd rather go somewhere else. There's the spot uranium price. It has been moving up of late, but please see my previous comments about the fact that that does not necessarily translate to higher prices for the producers or emerging producers. And there's the crude oil chart as well. So we're sort of hanging around in this low $60 area. Wrapping it all up, becoming a great investor is there for the taking. You've just got to want it enough to do the few simple things that are needed. The first thing that you need to do is to wash out all the conditioned junk that is lurking around in your head, the things that you've heard and you've perceived and you've been convinced are correct that just aren't. Now, you can't wash all that stuff out unless you've got something else to replace it with. So you need to replace it with a focus on a reliable, consistent process. And again, let me say for the umpteenth time, this is really quite a quick and simple process, but it's one that most investors probably just need a little bit of guidance because they're not really quite sure what is possible. So it is simple to put that together. That's the message. And the bonus that you get from that, and this is huge, is that every decision, once you've got a clear track to run on, every decision after that just becomes that much easier, that much more obvious. You don't have to agonize about, do I buy this or sell that? Or how much do I do? All those decisions are virtually taken care of. So it makes investing a much lower stress exercise. It just requires some courage to be honest with yourself about where you're at as an investor. And if you've got things that need to change, then be prepared to change them. Just get a bit focused on doing and thinking differently. And the results that you can get from investing can potentially rise very, very significantly. And we're seeing it. The feedback I'm getting from members about the change since they became members of Specialist Share Education, the change that it's brought to their investing results is really quite staggering. So think about attaching yourself to someone who really understands the dynamics of the market, not just conventional wisdom. It's just such an important point. Now, portfolio analysts last week, as I indicated last Sunday, we did a gold stock review, both fundamentally and technically, looking at my favoured stocks in both America and Australia, both producers and emerging developers as well. Alrighty, there's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.